In January 2026, silver hit an all-time high, about $121 per ounce, a genuine record. Precisely, around $121.62. Headlines called it silver's golden moment. 5 months later, that moment was gone. By June 26th, it traded near $56.50. That is roughly a 47% collapse. Months, not years, erased nearly half its value. 47% is hard to picture as a number. So make it concrete. Imagine a home worth $500,000. Now imagine it worth $265,000 by summer. Same house, same bricks, nearly half the price. That is the scale of silver's fall. Put $100 in, walk out with 53. And that happened in a single metal. The worst of it came in a flash. Silver lost roughly 12% in 2 trading days. 2 days, not 2 weeks. Screens turned red faster than people could react. Over the past month, it fell about 26%. It reached a 7-month low. Almost overnight, the gains unwound. This is a story about a market mania, about why crowds chase a rising price, about the comfort of buying what others buy, and what happens when that crowd turns around. It is also a story we keep retelling. Only the asset at the center keeps changing. To understand the crash, start with the metal. Silver has been money for thousands of years. Coins, jewelry, a quiet store of value. Empires were built and traded on it. People reached for it when paper money failed. But silver lives a second, very different life. It is also a hard-working industrial metal. It conducts electricity better than almost anything. That second life is the key to everything. Picture silver wearing 2 hats at once. One hat is precious like gold. It promises safety when the world feels fragile. The other hat is industrial like copper. Solar panels, electronics, electric vehicles all need it. Every smartphone holds a tiny trace of it. 2 identities mean 2 very different sets of buyers. Most of silver's demand is not for saving. A large share is consumed by industry. It is wired into the modern economy itself. Solar growth alone swallows huge amounts of it. That ties silver to the business cycle. When growth fears rise, industrial demand wobbles. Gold never carries that factory floor baggage. This split is why silver behaves so wildly. Gold mostly answers to fear and faith. It is a near-pure store of value. Silver answers to that, plus the factory floor. So it reacts to fear and to growth. More forces pulling on it means bigger swings. Think of silver as gold with extra leverage. Silver is famously more volatile than gold. For a while, everything pushed silver higher. Solar and EV demand looked unstoppable. The green transition needed metal, lots of it. Gold was soaring, and silver rode along. Investors wanted a hedge against uncertain times. Inflation worries sent money toward hard assets. Every headline seemed to point one way up. Rising prices are their own advertisement. Each new high pulled in more buyers. And each new buyer pushed it higher still. Money flowed into silver funds and bars. Friends bragged about gains at dinner tables. A rally that feeds on itself feels invincible. Fear of missing out did the rest. In January 2026, the rally peaked. Silver reached about $121.62 per ounce, an all-time record alongside record-high gold. At the top, almost everyone felt confident. The doubters had mostly gone quiet. Caution sounded foolish when prices only rose. That confidence is exactly where danger hides. Then the story flipped. Nothing about solar or EVs collapsed. No factory suddenly stopped needing silver. The metal was still in high demand. The change was in the money, not the metal. Yet the price began to crater. Why? The biggest force was the Federal Reserve. Markets saw rising odds of a rate hike. About 83% odds by December. Hawkish means higher rates, held for longer. It signals the fight against inflation continues. And higher rates change every calculation. Here is the simple idea behind it. Cash in the bank now pays 4 to 5%. Silver pays you nothing at all. No interest, no dividend, no income. It just sits there, hoping to rise. When safe cash pays well, silver feels costly to hold. Economists call that the opportunity cost. So money rotated out of the quiet metal. Put yourself in an investor's chair. You have spare money and two choices. Leave it in cash and earn your 5%. Or hold silver and earn exactly nothing. When rates were low, that choice was easy. Silver gave up little to chase big upside. But a guaranteed 5% changes the math. Suddenly, doing nothing pays better than waiting. Higher rates also lifted the US dollar. Money chases the currency that pays more. The dollar climbed near a one-year high, around 101.80 on the dollar index. Silver is priced in dollars worldwide. A stronger dollar makes silver pricier abroad. Imagine buying silver in euros or yen. As the dollar rises, your money buys less. For those buyers, silver simply got costlier. Costlier metal usually means weaker demand. Dollar strength quietly pressed the price down, and the dollar and metals often move opposite. Two headwinds were now blowing at once. Then came heavy investor outflows. Money pulled out of silver funds in size. These funds must sell metal when investors exit. Each sale nudged the price a little lower. And lower prices triggered yet more selling. Selling begets selling on the way down. The same crowd that rushed in rushed out. It helps to see the machine underneath. A fund holds real metal to back its shares. When investors cash out, shares must be redeemed. To pay them, the fund sells actual silver. That selling pushes the market price down. A lower price scares the next investor out, which forces still more metal to be sold. Round and round the loop turns, faster down. At the same time, tech stocks sold off. Falling portfolios forced investors to raise cash. When you need cash, you sell what you can. Often that means selling your winners. Not what you want to sell, what you are able to. Even winning positions like silver got sold. Panic in one market spilled into another. Line them up: a hawkish Fed, a strong dollar, fund outflows, and a scramble for cash. Anyone alone would have stung. Arriving together, they overwhelmed the market. For forces, all pushing the same way. That is how a 47% crash happens. There is a classic gauge worth knowing. It is called the gold-to-silver ratio. Traders have watched it for centuries. It asks a simple question. How many silver ounces equal 1 ounce of gold? A higher ratio means silver is relatively cheaper. In January, the ratio sat around 50. By June, it jumped to about 68.6. It now took far more silver to match gold. That tells us silver fell faster than gold. Both dropped, but silver dropped much harder. Let's make that number physical. In January, 50 silver ounces bought 1 gold ounce. By June, you needed nearly 69 of them. Stack 69 silver coins beside 1 gold coin. That growing stack is silver losing ground. The same gold now costs far more silver. The ratio is a thermometer for relative weakness. And in 2026, it ran hot for silver. Remember silver's two hats. In a panic, the industrial side scares investors. They fear factories will slow and buy less. Silver is also a smaller, thinner market. The whole silver market is tiny beside gold. Small markets swing more on the same flows. So silver tends to fly higher and fall harder. Here is what confused many people. Real-world demand for silver stayed strong. Factories still wanted it for solar and chips. By every physical measure, silver was needed. Yet the price kept falling anyway. Silver even ran a record physical deficit. That means demand outran new supply. The world used more silver than it dug up. Textbooks say a shortage should push prices up. Here, the textbook seemed to break. The shortage was real, the price still fell. Financial selling overwhelmed the physical shortage. The paradox dissolves once you see the timing. A physical deficit builds slowly over months. It tightens supply quietly in the background. Financial selling hits all at once in days. So a slow shortage met a sudden stampede. In the short run, the stampede wins. The shortage may still matter later. But markets price emotion before they price scarcity. Think of two crowds pulling one rope. Factories pulled up, wanting more metal. Investors pulled down, dumping their holdings. This time, the investors pulled much harder. Financial flows are simply bigger and faster. Factories buy slowly. Traders sell in seconds. Price follows whoever pulls hardest, not who is right. So what does a 47% crash mean? Not that silver is suddenly worthless. Its industrial story is still very much alive. It means the financial bet got too crowded. Price corrected the crowd, not the metal. But who actually feels a move like this? Some everyday savers bought silver coins and funds. For them, the drop is a real, painful loss. Retirement balances tied to metals took a hit. Yet cheaper silver can help other people too. Solar makers and electronics firms pay less for it. One person's loss can be another's lower cost. If you're a saver, take a breath here. A single asset crashing is not the whole world. This is why people spread money around. No one holding has to decide your future. Volatile assets demand money you can leave alone. Forced sellers crystallize losses. Patient ones need not. Know what you own and why you own it. We have seen this shape many times. A boom, a record high, then a bust. Gold and silver both soared, then both fell. Tulips, tech stocks, housing, crypto coins. The names and assets keep changing. The asset changes. The human pattern rarely does. The lesson is older than any chart. The most dangerous moment is peak optimism. When everyone owns it, who is left to buy? Without new buyers, a price cannot keep rising. The crowd that lifts you can also trap you. Chasing a rally late is chasing the exit. Silver rewards and punishes with the same force. The speed that thrilled buyers also trap them. The very swings that lure people can ruin them. Volatility is not a bug here. It is silver's permanent nature. Let's be honest, not dramatic. A crash genuinely hurts holders who bought high. Those losses are real and worth respecting. But the metal itself is not broken. Demand from real industry is still here. Lower prices can even attract patient industrial buyers. What might change the story from here? A softer Fed would lower cash's appeal. A weaker dollar would ease the pressure. Or that physical shortage could finally bite. Equally, rates could rise and deepen the fall. But none of these are promises. None of this is guaranteed in either direction. Reasonable people disagree about what comes next. Bulls point to the deficit and green demand. They see a metal the future cannot do without. Bears point to the Fed and the strong dollar. They see selling pressure that may not be done. Both arguments rest on real evidence. Honesty means holding both views at once. One important note before we close. This is analysis and education, not investment advice. We hold no view on what you should buy. Every investor situation is different. Past performance never predicts the future. A price is not a verdict on value. It is a snapshot of crowd emotion. It captures fear and greed in a single number. Silver's two hats simply amplify that emotion. Understanding the swing matters more than fearing it. Silver fell 47%, but the story is simple. Strong demand, yet far stronger selling. A boom, a peak, and a very human bust. The metal endures. The mania does not. That is the story behind the money. This has been Chronicle. Stay curious.